Here's the issue I have, and this is where we're going to disagree with a lot of people. That's after all taxes and after all overhead. I'm absolutely in love with this business. TRowe Price, we're going to look at the company. I love this company, and here's why. This is a 401k, basically 401k business. Every single week, every single pay period, people automatically put their money in their 401k from their paycheck. Yep. Automatically. Yep. It goes right in there. They generate more and more revenue as people put money in repeatedly over and over, markets up or markets down. Now, they do have portions of their money, portions of their revenue that are set fees versus based on assets under management. Right. But we're gonna take a look at the numbers, take a look at the 8 pillars, and then finally get to the point where we use our stock analyzer tool to decide what price to pay for the company. Now, if you're new to the channel, please listen. There'll be a lot of things that maybe seem overwhelming. They're not. Just listen to a few more videos, you'll get a hold of it. There's a reason why we have 187,000 subscribers. And also, if you like our software, everythingmoney.com, $7 for 7 days. We're running a special right now. Take a look at it, $7 for 7 days. So let's pull up TRowe Prizzle in our software. So Mo, from your perspective on this main page, tell me the things that you love.
So I love the gross profit margin.
It's 58%, guys. That means for every dollar they bring in, 58 cents of it goes to pay for overhead and taxes can be used for that.
I like the bottom line margin.
And then the bottom line margin is 30% last year, and the 5-year average is 35.5%. That's after all taxes and after all overhead.
The market cap to enterprise value might be the closest I've ever seen.
Guys, market cap to enterprise value. The difference here is basically the debt. This essentially says the company has no net debt after accounting for cash, etc. It's very difficult for companies to go broke. As an example, and I'm sure somebody will tell me there's a difference between Charles Schwab, 152 billion versus 523 billion. Okay, look at this dividend yield, Mo.
Yeah, I like it.
And on top of that, it's not like they're paying a huge dividend of 4% and eating up all their free cash flow. It's still about the 50% mark we want to be at on the 5-year average.
Yeah, I like it. And I like the return on invested capital, both the 1 year and the 5 year.
So the 1 year is 16.5, the 5 years is 18.4. The reason why return on invested capital is so important is if a company with a high return on invested capital wants to grow their profit, they don't have to invest as much money into the business to get that growth. If this was 5%, they got to invest, let's say it's 6%. They have to invest 3 times more money to grow their profit the same amount as a company with 18%.
Right.
That's the difference. And that extra money, they can use to buy back shares, pay down debt, do other things. Well, pay down what debt?
Well, there is no debt.
That's the great part. All right, Mo's on the 8-pillar page already.
This is something else I like. So if you guys are new, we use these 8 pillars. This is a screening process. So you don't see green check marks everywhere and go buy the stock. This just means, hey, things are looking really good. Now it's time to go a little bit deeper, which is what we're going to do right now.
Yeah. So look at these low PEs and low price to free cash flow. Now here's the issue I have, and this is where we're going to disagree with a lot of people. The typical value investor says you shouldn't care where you think the market's going. That's very difficult for me to do.
Yeah.
I look at this saying, if I believe the market is as overpriced as I think it is, this company will suffer as the market goes down. But man, this is already so cheap.
It's already cheap.
With such a high return on invested capital. Yep. I'm absolutely in love with this business. Like I look at it going, so one of the bull arguments to make for this company is they're also expanding the products they can have their investors and their 401k participants actually invest in. So it's not just going to be stock. They can do alternative investments and things like that as time goes on.
And when I look at the bear cases, they actually make me laugh. It is, well, they're a little bit more expensive than the rest of the industry, such as Charles Schwab or something. Okay, that doesn't bother me that much. And the second one is, if there's any type of recession, they're going to get hurt. Cool.
Is that really one of the bear cases?
Yes.
So the funny thing is, let's go look at the last big recession in the late 2000s.
Yeah, check it out. I mean, it's...
Look at their revenue.
Yeah, keep watching that.
It did drop and then rebounded.
How fast it rebounded.
Well, that was also how fast the market rebounded.
True.
But look at their profit.
That rebounded as well.
620, 660, 305, 630. I mean, it fell, but it was still profitable.
And I look at one of these businesses, how many people, I know, yes, people get panicked during down markets and scary times, but I don't think that the majority of people are just going to yank everything out. They're just going to keep investing, keep letting that automatic deposit just keep going, and that is a good thing for TRowe Price.
Yeah, exactly, because they're used to it.
Yes.
The other thing I love is free cash flow. It's cash from operations less your capital expenditures. This company, look at the capital expenditures as a percentage of their cash from operations. It's less than 10%. Here, it's a little bit over. Guys, it's not a capital intensive business. They don't have to keep reinvesting back in the business to maintain the business. It's not like a factory. We have to keep upgrading equipment, upgrading factories, replacing roofs. No. This is a business that their main goal is go get more signups. And as the world expands, hopefully they're able to do the same thing.
Right.
So let's look at analyst estimates and see where analysts think this company is going to go in terms of earnings per share. Now remember, we don't take analyst numbers as set in stone. We actually kind of somewhat laugh about it, but it's a nice way for people to get a perspective because some of these analysts do spend a lot of time with the companies. Mo, what's that face for?
I'm just looking at analyst estimates on the revenue side. And there's
dropping.
basically, it's dropping. Very little growth out to end of 2026. Earnings per share side, definitely more actually.
But here's the thing,
single digits.
Without revenue growth, because of that high return on invested capital, they can still maintain that profit very well.
Exactly.
And that's the big key.
Exactly.
All right, so let's look at the stock analyzer tool. Now remember, like I said before, the stock analyzer tool is what we use, Mo and I use every single day without looking at the balance sheet, which remember, this is a very, very strong balance sheet.
Yep.
Every investment is the present value of all future cash flow. We don't know the future. We have to make estimations. I'm going to do a 20-year analysis. Mo's going to do a 10-year. Now, the one thing I want you guys to remember, the further out you go, the wider the spread will be in your assumptions, okay? It's just like spraying a shotgun. The closer you are, the closer the distance is. As you go out further, it's gonna be much further apart. And that's okay. The goal about value investing is that when it becomes obvious to you as to where the stock should be.
Right.
Okay? Now, we're gonna make these assumptions. And if it's all green, it doesn't mean go out and buy necessarily. Do more research. That's the other reason to sign up for $7 for 7 days. It's worth it just to do it if you have one company you want to talk to, because the EM community with thousands of people in it give you an opportunity to go in there and have a conversation. So let's do our growth assumptions, Mo.
Okay.
Now this is, yeah. But I have a feeling that this number is going to be all green. We're already at 114 on TRowe Price. It's down 3.6% today. Why is it down so much today?
I don't know.
Is there any news? We'll look at that. Hang on a second. Let me check out the news on TRowe, and we can look at the news on our own website. TRowe Price gains. Okay, that was 1 week ago. Okay, there's not much news out there on it. All right, Mo.
Yeah.
Give me your growth, your numbers, and I'll go line by line with you.
Okay, so revenue growth, I did 2, 4, and 6.
I did 3, 5.5, and 8, but I will say this. I do agree with Mo because I do believe that the next 10 years for the market will be harder.
Yeah.
But I still think he's being conservative, but that's my opinion.
Yeah. I think that probably 5 is probably somewhere in the right range, but this is what I would be looking at. This is projecting bad times for the next decade. Okay.
Profit margin.
28, 32, 36.
I did 30, 32, and 34.
Okay. Free cash flow margin, 26, 29, 32.
I did the exact same thing.
PE, 14, 16, 18.
I did 15, 16, 17. Okay. Even though the current PE is 12 and price of free cash flow is 10, I did 15, 16, 17 for both because I look at it going low, great balance sheet, high return on invested capital. If anything, I can make the argument that this is way too low. All right, return.
10, 12, and 14.
I did the same thing. Now remember, guys, this 10% is pretty low. You can get 10% in the market, but I already beat it up like crazy. So I'd rather have TRowe Price at these assumptions than the market in general.
Right.
So hit the analyze button. The stock's currently at 115, 114. What'd you get, Mo?
I'm seeing green. 106 to 114, 152 to 171, middle ground 128 to 141. My watch list is at 100.
I have a low price of 117, a high of 184, and 150 in the middle. I have it on my watch list at 110. In full disclosure, I have puts on it at varying levels, and I'm sure I'm gonna get assigned shares here soon. And don't go buy it just because I might get it. But guys, $7, 7 days, check it out. Go sign up on everythingmoney.com. Thank you very much. Take care.